Welcome back to Satoshi Finance viewers, and our insightful exploration of the intricate relationship between inflation and investments. Inflation, a term familiar to many but often misunderstood, lies at the heart of economic dynamics, shaping the financial landscape in profound ways. At its core, inflation refers to the persistent increase in the general price level of goods and services over time. This phenomenon holds significant implications for economies worldwide, influencing everything from consumer purchasing power to corporate profitability and government fiscal policies. In this video journey, we embark on a journey to demystify inflation and its profound impact on investment strategies. We begin by elucidating the concept of inflation, delving into its economic significance and the mechanisms driving its rise. From there, we pivot to explore how inflation permeates the realm of investments, affecting asset classes ranging from stocks and bonds to real estate and commodities. By grasping the fundamental dynamics at play, viewers will gain a deeper understanding of how inflation can shape the performance and value of their investment portfolios. Lastly, we outline the structure of our discussion, providing a roadmap for the insights and strategies we'll uncover to help investors navigate and thrive in an inflationary environment. So sit back, relax, and join us as we embark on this enlightening journey into the impact of inflation on investments. To truly grasp the impact of inflation on investments, it's imperative to first understand the intricacies of inflation itself. Inflation manifests in various forms, with demand pull and cost push being prominent types. Demand pull inflation occurs when demand for goods and services surpasses their supply, leading to upward pressure on prices. Conversely, cost push inflation arises from increased production costs, such as higher wages or raw material prices, prompting businesses to raise prices to maintain profit margins. These nuanced variations underscore the complex interplay of factors driving inflationary trends in economies. One of the most notable consequences of inflation is its ability to gradually erode the purchasing power of money over time. As prices rise, each unit of currency buys fewer goods and services, diminishing the real value of savings and investments. This erosion can have profound implications for investors, as it diminishes the returns generated by investment portfolios and alters the risk-return dynamics of various asset classes. Understanding this phenomenon is crucial for investors seeking to preserve and grow their wealth amidst fluctuating economic conditions. Furthermore, inflation exerts differential effects on various asset classes, reshaping their performance and attractiveness to investors. Stocks, for instance, may benefit from inflationary environments due to companies' ability to increase prices and revenues. Bonds, on the other hand, typically experience diminished purchasing power of their fixed coupon payments, reducing their real returns. Real estate often serves as a hedge against inflation, as property values and rental incomes tend to rise alongside prices. Commodities, particularly those with intrinsic value like gold and oil, can also serve as effective inflation hedges. By dissecting these impacts across asset classes, investors can strategically position their portfolios to mitigate inflationary risks and capitalize on emerging opportunities. Examining historical examples of high inflation provides invaluable insights into the profound impact this economic phenomenon can have on investments and societies at large. Two notorious cases of hyperinflation are those of Germany in the early 1920s and Zimbabwe in the late 2000s. In post-World War I Germany, hyperinflation reached astronomical levels, with prices doubling every few days. This extreme inflationary environment devastated the German economy, wiping out savings and leading to social unrest. Similarly, Zimbabwe experienced hyperinflation in the late 2000s, with prices skyrocketing at an alarming rate. The Zimbabwean dollar became virtually worthless, causing widespread economic instability and humanitarian crises. During these periods of hyperinflation, traditional investments like stocks and bonds often failed to preserve wealth. Stock prices, while nominally rising, were unable to keep pace with inflation, resulting in significant losses in real terms. Bonds, with their fixed coupon payments, suffered even more, as the purchasing power of these payments rapidly diminished. Real assets like real estate and commodities tended to fare better, as their values were linked more closely to tangible goods and services. However, even these assets faced challenges in maintaining value amidst the chaos of hyperinflation. The long-term implications of these episodes serve as cautionary tales, highlighting the importance of proactive measures to safeguard investments against the erosive effects of inflation. Mitigating the impact of inflation on investments requires a proactive approach, and one key strategy is diversification. By spreading investments across different asset classes, investors can create a more resilient portfolio capable of weathering inflationary storms. Diversification helps hedge against the specific risks inherent in any single asset class, ensuring that losses in one area may be offset by gains in another. This strategy also enables investors to capture opportunities across various sectors and regions, enhancing the overall risk-adjusted returns of the portfolio. Investing in real assets is another effective strategy for combating inflation's erosive effects. Real assets, such as real estate, commodities, and infrastructure, have intrinsic value derived from physical properties or utility. During inflationary periods, the prices of real assets often appreciate, providing a natural hedge against rising prices. Real estate in particular can offer stable cash flows and capital appreciation potential, while commodities like gold and oil historically maintain value or even appreciate during inflationary environments. Additionally, investments in infrastructure, such as toll roads or utilities, can provide reliable income streams that are less susceptible to inflationary pressures. Treasury Inflation-Protected Securities, TIPS, are specialized bonds issued by the U.S. Treasury designed to protect investors from inflation. Unlike traditional bonds, the principal value of TIPS adjusts with changes in the Consumer Price Index, CPI, ensuring that investors receive a fixed real return. This inflation-indexed feature makes TIPS particularly attractive during inflationary periods as they offer a guaranteed hedge against rising prices. Including TIPS in a portfolio can provide stability and preserve purchasing power, making them a valuable component of an inflation hedging strategy. Investing in stocks of inflation-resistant companies is another avenue for investors seeking protection from inflationary pressures. Certain industries or sectors tend to perform well during inflationary periods due to their ability to pass on increased costs to consumers or benefit from rising demand. These industries include consumer staples, healthcare, utilities, and natural resources. Companies operating in these sectors often possess pricing power, strong brand loyalty, or essential products and services, enabling them to maintain profitability despite inflationary headwinds. By selectively investing in stocks of inflation-resistant companies, investors can enhance the resilience of their portfolios and capitalize on opportunities arising from inflationary trends. Considering international investments can be a strategic move for investors looking to diversify their portfolios and mitigate the impact of inflation. Investing in foreign markets provides exposure to different economic conditions, currencies, and geopolitical factors, which may not correlate with domestic market performance. This diversification helps spread risk and can enhance overall portfolio resilience. Additionally, investing internationally offers opportunities for growth and access to industries or sectors that may be underrepresented or unavailable in domestic markets. By allocating a portion of their portfolios to international investments, investors can benefit from potential returns while reducing exposure to single-country risks and currency fluctuations. Rebalancing and adjusting portfolio allocation are essential practices for maintaining a portfolio's inflation-fighting characteristics over time. Periodically reassessing asset allocations and rebalancing ensures that the portfolio remains aligned with the investor's risk tolerance, financial goals, and prevailing market conditions. During inflationary periods, certain asset classes may outperform others, leading to deviations from the target asset allocation. By rebalancing, investors can trim overweight positions and reallocate funds to assets that may better withstand inflationary pressures. This disciplined approach helps protect against portfolio drift and ensures that the portfolio remains well-positioned to preserve purchasing power and achieve long-term financial objectives. Utilizing inflation hedges is a critical component of an effective investment strategy in inflationary environments. Alternative investments like gold, inflation-indexed annuities, and cryptocurrencies offer unique characteristics that can help investors hedge against the erosive effects of inflation. Gold, for instance, has long been considered a store of value and a hedge against inflationary pressures due to its intrinsic worth and limited supply. Inflation-indexed annuities provide guaranteed income streams that adjust with inflation, offering protection against rising prices and ensuring a steady standard of living in retirement. Cryptocurrencies, while volatile, offer decentralized and inflation-resistant assets that may serve as a hedge against fiat currency depreciation. By incorporating these inflation hedges into their portfolios, investors can enhance diversification and safeguard against the uncertainties of inflationary environments. Examining real-life case studies and practical examples provides valuable insights into how investors have successfully navigated inflationary environments and the outcomes of different investment strategies during such periods. For instance, during the hyperinflation in Zimbabwe in the late 2000s, some investors turned to alternative assets, like gold and foreign currencies, to preserve their wealth amidst the rapid depreciation of the local currency. Others diversified their portfolios internationally, investing in assets denominated in stable currencies and benefiting from the relative strength of those economies. Similarly, historical case studies, such as the stagflationary period of the 1970s in the United States, offer valuable lessons. During this time, stocks performed poorly in real terms due to high inflation and stagnant economic growth. However, certain industries, such as energy and commodities, experienced significant gains as their prices surged alongside inflation. Real estate also proved to be a resilient investment during this period, with property values and rental incomes rising to keep pace with inflation. By examining these case studies, investors can glean insights into the effectiveness of various investment strategies in mitigating the effects of inflation and positioning portfolios for long-term success. While inflation hedging strategies offer potential benefits, they also come with inherent risks that investors must carefully consider. One significant risk is the possibility of overexposure to a single inflation hedge, which can increase portfolio volatility and reduce diversification benefits. For example, investing heavily in commodities like gold or oil can expose investors to price fluctuations and geopolitical risks specific to those markets. Similarly, relying solely on inflation-indexed securities like TIPS may lead to missed opportunities for growth or income in other asset classes. Moreover, some inflation hedges, such as cryptocurrencies, are highly speculative and subject to regulatory uncertainty, making them vulnerable to sudden price swings and liquidity risks. Implementing inflation hedging strategies effectively can also pose challenges for investors. One challenge is accurately forecasting inflation and adjusting investment allocations accordingly. Inflation rates can vary widely over time and across regions, making it difficult to anticipate future inflation trends with precision. Additionally, implementing inflation hedging strategies often requires active portfolio management and rebalancing, which can incur transaction costs and tax implications. Furthermore, selecting the right mix of inflation hedges requires thorough research and analysis to align with investors' risk tolerance, investment goals, and time horizon. Balancing the trade-offs between inflation protection and portfolio performance can be complex, requiring careful consideration of each strategy's costs and benefits. By addressing these risks and challenges proactively, investors can enhance the effectiveness of their inflation hedging strategies and better navigate the uncertainties of inflationary environments. In conclusion, the impact of inflation on investments is profound and multifaceted, influencing asset values, portfolio performance, and investors' purchasing power over time. We've explored how inflation erodes the real value of money, affecting various asset classes differently and presenting both challenges and opportunities for investors. It's crucial to recognize that inflation is not a static force, but a dynamic economic phenomenon that requires vigilant monitoring and proactive management of investment portfolios. Throughout this discussion, we've emphasized the importance of being proactive in managing investment portfolios in inflationary environments. By diversifying across asset classes, investing in real assets, and utilizing inflation hedging strategies, investors can mitigate the adverse effects of inflation and position their portfolios for long-term growth and resilience. Additionally, we've highlighted the significance of periodically rebalancing portfolios and adjusting allocations to maintain their inflation-fighting characteristics in response to changing market conditions. As you navigate the complexities of inflation and investments, we encourage you to further research and consult with financial professionals for personalized advice tailored to your unique financial goals and circumstances. By staying informed, remaining vigilant, and seeking professional guidance when needed, you can effectively navigate the challenges posed by inflation and build a robust investment strategy capable of withstanding the test of time. We sincerely thank you for tuning into our exploration of the impact of inflation on investments. Your engagement and interest in understanding these critical financial concepts are truly appreciated. If you found this video insightful and valuable, we kindly ask you to consider supporting our channel by liking, sharing, and subscribing. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you.